Trump said Canada would come crawling. He said it publicly, confidently, the way a man says something he believes is already settled. Cut off from American markets, squeezed by tariffs, isolated and dependent, Canada would have no choice but to return to the table, hand in hand, ready to accept whatever terms Washington offered. That was the prediction. That was the whole strategy. And for a while it looked plausible, because on paper Canada really did depend on the United States more than almost any developed nation depends on any single partner. But Canada didn't come crawling. Instead, Mark Carney signed a deal that sent a shock through Wall Street, and the reaction told you everything about who had actually been holding the weaker hand. This is the story of that deal, what it actually contained, and why it rattled markets that were supposed to be cheering for the American side. Before we get into it, hit subscribe right now, because this story is still moving and the next part matters even more. Let's start with the prediction itself, because the confidence behind it was the entire point. Canada will come crawling wasn't just a taunt, it was a strategy stated out loud. The whole pressure campaign depended on one belief, that Canada had no alternative, that its dependence on the American market was so total that resistance was impossible. 75% of Canadian exports flow to the United States. That single number was supposed to be the leash. Threaten the market Canada cannot live without, and Canada folds. It was a clean theory, and it had worked before in smaller disputes, so Washington assumed it would work again, and it said so publicly, which is exactly why what happened next stung so much, because Carney did not fold. He did the opposite of folding. Rather than returning to Washington to soften the terms, he turned outward and signed an agreement that deepened Canada's trade ties with markets beyond the United States, Europe, and other economies actively looking for stable, resource-rich, politically reliable partners. In one signature, he took the leash Washington believed it was holding and cut it. He didn't cancel the American relationship, he simply proved it was no longer the only relationship that mattered. And that was the move nobody in Washington had genuinely prepared for, because their entire strategy had assumed it was impossible. Now here is the part that surprised people the most, the reaction on Wall Street. You would expect American markets to shrug off a Canadian trade deal, or even to welcome it as a sign of reduced tension. Instead, the deal rattled them. And to understand why, you have to understand what the deal actually threatened. American markets had spent decades pricing in one assumption, that the deeply integrated North American supply chain was permanent. Automakers, manufacturers, energy firms, agricultural processors, an enormous web of American business was built on the certainty that Canadian goods, Canadian energy, and Canadian parts would always flow south on predictable terms. Carney's deal put a crack in that certainty. And markets do not like cracks in things they assumed were permanent. Here is the number that should genuinely catch your attention. The trade corridor between Canada and the United States moves well over $100 billion in goods every single year. Autos, energy, minerals, agriculture, manufacturing components, much of it crossing the border multiple times before a finished product ever reaches a shelf. That integration was profitable precisely because it was predictable. The moment Canada signaled it could redirect even a fraction of that flow toward other markets, every business model built on the old assumption suddenly carried a new risk. Wall Street wasn't reacting to a foreign policy headline. It was repricing the reliability of a supply chain it had treated as untouchable for a generation. Because that's what markets actually do. They don't panic over insults or threats. They react to changes in certainty. Trump's tariff threats, loud as they were, didn't fundamentally alter the assumption that Canada would remain dependent and integrated. Carney's deal did. It introduced a genuine question mark into a system that had never had one. If Canadian energy could find European buyers, if Canadian minerals could flow toward Asian manufacturers, if Canadian producers built lasting alternatives to the American market, then American firms that relied on cheap, guaranteed access to those goods suddenly faced a future they had never modeled. That uncertainty is what moved the markets, and it moved them in the wrong direction for the people who had predicted an easy American victory. Now let's talk about who actually benefits from keeping a country dependent, because that's where this story gets sharper. Dependence is never neutral. It's a structure, and structures serve someone. For decades, specific American industries profited enormously from Canada's captive position, cheap, reliable inputs from a neighbor with nowhere else to sell. That arrangement looked like partnership, but underneath it was leverage, and leverage is only valuable as long as the other side stays trapped. The people who profited most from Canadian dependence were also the people with the most to lose if Canada ever found the door. Carney's deal threatened exactly that arrangement, and the market reaction was, in part, those interests recognizing the shift. And Carney understood this dynamic completely. He didn't stumble into the deal. He named the underlying problem out loud, well before he signed anything, telling his own country that Canada's overwhelming reliance on a single customer had become a genuine weakness, one that required urgent correction. That statement wasn't aimed at Trump. It was aimed at Canadian industry, Canadian investors, and Canadian voters. It was a signal that the era of assuming the American market would always be there, always on American terms, was ending. And once a country's leadership commits to that publicly and then acts on it, the entire negotiating relationship changes permanently. The reaction inside Canada reinforced the strength of the move rather than undermining it. Provincial leaders whose economies lean heavily on cross-border trade backed the harder line rather than fearing it, signaling readiness to match American pressure dollar for dollar instead of absorbing it quietly. That unity mattered enormously, because a diversification strategy only works if the country stands behind it. A divided Canada would have exposed the deal as a bluff. A united one turned it into a credible long-term shift. And when a supposedly cornered nation responds with coordinated confidence instead of scattered fear, the side that predicted crawling discovers it badly misread the room. The broader context made the deal land even harder. This confrontation didn't happen in a vacuum. It came against a backdrop of fraying trade agreements and constant renegotiation, where the old predictable rules had been replaced by perpetual uncertainty. Washington's approach had been to keep partners permanently off balance, never sure what the next demand would be. But that strategy carried a hidden cost. It gave those partners every reason to build alternatives. Carney's deal was the logical consequence of that pressure. If the American relationship was going to be unstable and unpredictable, then depending on it completely was no longer rational. Washington's own tactics had quietly manufactured the incentive for Canada to walk. So why did Wall Street react while Washington's political side projected confidence? Because markets and politicians measure different things. Politicians measure narratives: who looks strong, who looks weak, who blinked first. Markets measure risk, and risk is cold and unsentimental. The political story was still Canada will come crawling. The market story was a reliable supply chain just became less reliable. Those two stories pointed in opposite directions, and the market's version was the honest one. Wall Street wasn't cheering the American side because Wall Street understood that a more independent Canada meant a less controllable input for American business. The confident prediction and the market reaction couldn't both be right, and the money sided against the prediction. Because leverage at its core is never about size, it's about alternatives. The bigger economy doesn't automatically win. The side with somewhere else to go sets the terms because it can walk away without collapsing. Trump had the larger economy, the louder threats, and the confident prediction. Carney had something more valuable: a credible, signed, real alternative. And the moment that alternative became concrete rather than theoretical, the leverage quietly changed hands. The deal didn't just help Canada. It exposed how much American business had been relying on Canada having no choice, and markets priced that exposure the instant they saw it. Now here is what to actually watch for in the months ahead. Watch whether the new trade relationships translate into real, sustained volume, or whether they remain symbolic gestures that fade once tensions cool. Watch how American industries dependent on Canadian inputs respond, whether they lobby quietly for de-escalation now that the leverage has shifted. Watch whether the tariff threats that started all of this ever fully materialize, or whether they shrink as Washington realizes the crawling never came. And watch the markets themselves, because they will tell you the truth faster than any politician will. If cross-border trade stocks stay jittery, it means the repricing is real and ongoing, not a one-day reaction. Because the truth is, this story was never really about who blinked first. It was about certainty and who was actually depending on whom. Everyone assumed the dependence ran one way, that Canada needed America and America simply held the whip. Carney's deal revealed the hidden half of that equation. American business depended on Canadian goods, flowing cheaply and reliably just as much as Canada depended on American buyers. The prediction that Canada would crawl assumed a one-sided relationship. The market reaction proved the relationship went both ways all along, and that both sides had far more to lose than the confident version admitted. Trump framed the confrontation as a desperate country facing an unavoidable choice, destined to return on its knees. Carney answered by signing a deal that made the choice avoidable, and the market's reaction did the rest. Wall Street didn't break because Canada was weak. It flinched because Canada was suddenly, credibly strong enough to walk. And that is the difference between a headline and the real story. The headline says Canada would come crawling. The real story says Canada found the door, signed its name, and let the markets deliver the verdict that no politician wanted to say out loud, that the leverage was never as one-sided as the confident prediction claimed. If this breakdown helped you understand what the headlines left out, hit subscribe right now for more deep dives exactly like this one. Drop a comment and tell me, did Carney genuinely outplay Washington, or will the markets settle and prove this was all short-term noise? I read every comment, and your thoughts genuinely help this channel reach more people who need to hear this. Thank you for watching, and I'll see you in the next breakdown.